After you turn 60, something quietly changes in your financial life, and almost nobody warns you about it. There are five specific things the IRS begins to take from you year after year, and most of them are taken so quietly through rules so old and so buried that you may not even notice it is happening until it has cost you tens of thousands of dollars. These are not penalties for doing something wrong. You did everything right. You worked, you saved, you played by the rules your whole life, and precisely because you did, the system has five mechanisms waiting for you in retirement, each one designed to take a piece of what you built. By the end of this video, you will know exactly what those five things are, why they hit hardest after 60, the real story of how they cascade together to catch even careful savers, and the specific moves that let you keep your money instead of quietly handing it over year after year to a system that is counting on you never noticing. Before I go one more sentence, let me clear up the thing that causes the most damage. You might think this is only a problem for wealthy retirees, that if you are not rich, the IRS has no reason to come after your money. That is exactly backwards. The five things I am about to show you were originally designed decades ago to affect only the wealthy. But through frozen thresholds, inflation, and forced withdrawals, they now reach squarely into the middle class. The retired teacher, the former nurse, the couple living carefully on a pension and Social Security. If you have retirement savings at all, this affects you. The people who get hurt worst are not the rich. They are ordinary retirees who assume none of this applies to them. I am not a lawyer, CPA, or financial advisor. Everything here is educational and based on current 2026 tax rules and public information. My name is Kevin, and on this channel, I take retirement tax traps and explain them in plain English before they cost you money. Let's start with the first thing the IRS takes. Number one, the IRS takes up to 85% of your Social Security and pulls it into your taxable income. Most retirees do not believe this when they first hear it. You paid into Social Security your entire working life. Money came out of every paycheck. You funded the system with after-tax dollars. So naturally, most people assume their benefits will come back tax-free. But depending on your income, up to 85% of your Social Security can be counted as taxable income and taxed again. The IRS uses something called provisional income to determine how much of your benefit becomes taxable. For a single filer, the key thresholds are $25,000 and $34,000. For married couples, $32,000 and $44,000. Here's the part that shocks people. Those thresholds were created decades ago and have never been adjusted for inflation. What counted as wealthy income in the 1980s now looks like ordinary middle-class retirement income. As costs rose, the thresholds stayed frozen. Every year, more retirees crossed those lines, not because they got richer, because inflation happened. Imagine a retiree collecting $24,000 in Social Security and withdrawing $18,000 from a retirement account. Half of Social Security counts toward provisional income. Suddenly, that retiree is already over the first threshold. Add a small pension or extra withdrawal, and up to 85% of Social Security becomes taxable. The raise that was supposed to help through inflation can actually trigger more taxation. That is how quietly this first trap works. Now, let me give you the second thing the IRS takes, and this one is even more direct. After a certain age, the IRS forces you to withdraw your own retirement savings, whether you need the money or not, and then taxes every dollar. For your entire working life, you were told to save in traditional IRAs and 401ks. The money went in before taxes, it grew tax deferred, and you were told you would pay taxes later. But the IRS was always planning to collect. Once you reach the required age, currently 73 for most retirees, the government forces you to start taking required minimum distributions. These are called RMDs. The word required is not a suggestion. It is a command. It does not matter whether you need the money. It does not matter if you would rather leave it invested. The IRS forces it out. A retiree with $800,000 in a traditional account could be required to withdraw roughly $30,000 in the first year alone. Every dollar becomes taxable income. For decades, you thought that retirement account was entirely yours, but a portion of it always belonged to the IRS. You never avoided the taxes, you only delayed them. And when required distributions begin, the IRS finally collects on its schedule, not yours. And if you fail to take the required withdrawal, the penalty can be severe. The government does not simply ask, it penalizes. That is the second thing the IRS takes after 60, control over your own retirement savings. And now these first two traps combine into something even worse. Number 3, the IRS uses your forced withdrawals to raise the cost of your Medicare. This one does not feel like a tax. It feels like a healthcare bill. Medicare premiums are not fixed for everyone. If your income crosses certain thresholds, you pay additional surcharges. This is known as IRMAA, the Income-Related Monthly Adjustment Amount. The key thing to understand is what triggers it: income. And what raises income in retirement: required withdrawals and taxable Social Security. The IRS forces money out of your retirement account. That increases your income. The higher income pushes you across Medicare surcharge thresholds. Suddenly, your premiums jump, sometimes by hundreds of dollars per month, thousands per year. At the highest tiers, retirees can pay more than $600 monthly for coverage that costs others less than $200. The worst part is that Medicare looks back 2 years. A large withdrawal today may increase your premiums years later. Many retirees receive the higher bill and have no idea what caused it. The trigger happened long ago. That is the third thing the IRS takes. It uses your own income against you and quietly raises healthcare costs. Now let me give you the fourth thing, because this is the one almost nobody understands. Number 4, the IRS takes more from every extra dollar than you think through something called the stacking effect. Most retirees believe they know their tax bracket. Maybe you think you are in the 12% bracket, so an extra $1,000 should cost about $120 in tax. Simple. Except retirement taxes often do not work that way. Every additional withdrawal can trigger another effect. It can pull more of your Social Security into the taxable zone. Imagine you withdraw an extra $1,000. You think you are paying tax on $1,000. But that withdrawal also causes another $850 of Social Security to become taxable. Now the IRS is effectively taxing $1,850 instead. Your real tax rate may not be 12%. It may be 22%, 30%, sometimes even higher. Financial planners call this the tax torpedo. The hidden stacking effect quietly multiplies the tax burden. Many retirees never notice it. Their software may not explain it. Their tax preparer may never mention it. Yet it happens every year. That is the fourth thing the IRS takes. More than its stated tax rate. Far more. And now we arrive at the fifth thing, the one that hurts the most. Number 5. After 60, the IRS takes your best tax-saving years away from you simply by letting the clock run out. Between retirement and age 73, there is a special window, a precious period when income is often at its lowest. You may not yet be taking full Social Security. You are not yet forced to take required distributions. And because your income is lower, your tax rates are often lower too. This window is one of the greatest tax planning opportunities of your entire life. But most retirees never realize it exists. They do nothing. Year after year passes. Then age 73 arrives. The forced withdrawals begin. Social Security taxation increases. Medicare surcharges appear. And suddenly the window is gone forever. The first 4 traps are things the IRS actively does. The 5th requires the IRS to do nothing. It simply waits. The most expensive thing that happens to many retirees is not an action the government takes. It is the action they never take because nobody told them the opportunity existed. The window opens quietly. It closes quietly. And many retirees never know it was there. So now let me show you how to fight back, because every one of these traps can be reduced, and some can be avoided almost entirely. The most powerful strategy is a Roth conversion. During low-income years, you move money from traditional retirement accounts into a Roth account. You pay taxes now while your income is lower, but afterward, the money grows tax-free. Withdrawals are tax-free, and most importantly, Roth withdrawals do not count toward provisional income. That means they do not pull more Social Security into taxation, and they do not push you toward Medicare surcharges. You are paying a smaller, controlled tax today to avoid a larger, forced tax later. Done strategically over several years, Roth conversions can save tens of thousands of dollars. Another powerful strategy is the qualified charitable distribution. If you already donate to charity, you may be able to send money directly from your retirement account to the charity. The withdrawal satisfies your required distribution, but it never becomes taxable income. The charity receives the money, you avoid the cascade of taxes and surcharges. A third strategy is controlling where you withdraw money from. Traditional accounts, Roth accounts, savings. Each affects taxes differently. Two retirees can spend exactly the same amount of money and end up with dramatically different tax bills simply because they pulled money from different sources. Where you withdraw from matters just as much as how much you withdraw. There is also currently an additional senior deduction available for many retirees. It is temporary. It will not last forever, and many people do not realize it exists. Ask about it directly. Do not leave money on the table. Let me tell you a quick story. Imagine a couple in their late 60s. They worked hard, saved diligently, built more than $1 million in retirement accounts. For years, their income remained modest. Their taxes stayed low. Life felt comfortable. Nobody told them about the window. Nobody explained Roth conversions. Nobody showed them the future consequences. So they did nothing. Their accounts continued growing. Then age 73 arrived. The forced withdrawals began. The withdrawals were enormous. Those withdrawals pushed 85% of their Social Security into the taxable zone. Their taxable income surged. 2 years later, Medicare surcharges arrived. Healthcare costs jumped. The stacking effect multiplied the taxes. Every one of the 5 traps hit them at once. Not because they were careless, not because they made mistakes, because nobody told them the window existed. That is the lesson. The system does not punish reckless people. It quietly collects from careful savers who were never shown the roadmap. After 60, the IRS has 5 mechanisms waiting: taxable Social Security, required withdrawals, Medicare surcharges, the stacking effect, and the disappearing tax planning window. But now you know they exist, and knowledge changes everything. If you are in your 60s, recognize that you may be standing inside the most valuable tax planning window of your life right now. Do not let it close without understanding your options, because the most expensive choice is often the one that feels safest: doing nothing.